I don't think that leverage is inherently wrong, but I would be leery of somebody who's using too much leverage in their fund, too much dependent on leverage to generate the returns. I think at the end of the day, when you're making investments, you want to make sure there's a fundamental case for it. Using capital intelligently, that's always a smart thing.
This is the Real Asset Intelligence Podcast with your host, Derrick Barker, sponsored by Nectar. Access your trapped liquidity today at usenectar.com.
Welcome to Asset Intelligence. I'm Derrick Barker. For decades, the best private investments were locked behind a velvet rope. Private equity, private credit, private real estate. If you weren't an institution or family office, you were invited. But in 2026, that wall is coming down fast. These assets are showing up in everyday portfolios through individual funds, evergreen structures, tokenization, and now even a push into 401ks. So the opportunity here is real and legitimate, but the risks are as well. Today's guest quite literally wrote the book on doing it well. Tony Davidow is the Senior Alternatives Investment Strategist at Franklin Templeton Institute, host of the Alternative Allocations podcast, and the author of Private Markets, the guide advisors are using right now to bring these asset classes to regular investors. Tony, thank you for having us.
Derrick, thanks so much for having me.
Tony, thank you for joining. I hope I got that background right. Do you mind telling us a little bit about how you became the expert in this field?
Yeah, I think the obvious thing is I'm an old guy and I've been doing this for a long time, but I think apropos to your setup, I began my career working for a family office almost 40 years ago, spent significant time at Morgan Stanley where I ran three primary businesses. First, the institutional consulting business, and then later moved in working with our banking clients in a little business called Greystone. And at the end of my tenure, ran sales and training for the consulting services business across all three client segments: institutional, private wealth, and individual investors. And the reality, I think, as you pointed out, is these tools had historically been available to institutions and family offices. And as much as individual investors wanted to access private equity, private credit, private real estate, they really weren't broadly available. So I think I've had the unique vantage point of kind of watching the industry kind of evolve over the last several years. If I fast forward to today, my role in the Franklin Templeton Institute, as you and I were talking about beforehand, is I am singularly focused on helping advisors make better informed decisions about using these tools. I write white papers, I have a podcast, which you mentioned, I write blogs. But a lot of what I write and a lot of what I speak about really comes from my engagement with advisors and investors as they ask questions about how should we think about these tools? What role do they play in client portfolios? How should I think about these new structures coming to the market? Those are all topics that I tackle, but I try to tackle it through the lens of the advisor and the investors who are thinking about getting exposure, maybe for the first time.
Okay. So that's great. I love to just start there. So when an advisor calls you and says, "Hey, my client wants private credit exposure," or wants just generally private alternative investment exposure, what questions do you make sure that they're able to answer first, and where do most people get it wrong?
Yeah. I think maybe if I can, I'll take a little bit of a step back because I do think it sets the stage a little bit, and that is that probably up until 10 years ago, it was very difficult to access private credit, private equity, private real estate. Again, they were broadly available to the institutional and the ultra high net worth community. The typical investments in the first generation of product were qualified purchasers, 5 million or more in investable assets. So it's really only been in the last 10 years that you've started to see these products available in the wealth channel. And I'll just kind of point out there's three drivers that we think have really made this so appealing today. One is, I think 2022 was one of those years that served as a reminder that stocks and bonds were both down double digits, as you and I remember, and I suspect many of your guests may remember as well, which caused us to think, well, aren't these supposed to be diversified holdings? Isn't one supposed to offset the other? So it reminded us of the interconnectivity of investments, and it reminded us that we really do need a broader set of tools to solve for what our clients need. So I think the markets have been really dictating you need a more robust and reliable toolbox. Two, product innovation. And you mentioned evergreen funds in the beginning. Evergreen funds, these new funds coming to the market, are really much more geared towards individual investors and They provide a lot of the attributes of that first generation of fund, but they're a little bit more flexible. They're typically available to accredited investors and below. I like the term evergreen because it really describes they are on the shelf and available all the time rather than through a narrow subscription period. They're typically available at very low minimums, which means high net worth investors can actually have diversified exposure across private equity, private credit, private real estate. And they do have quarterly liquidity provisions. Now, I do want to address this head on because there's a lot of noise in the marketplace. These are illiquid investments. These should be viewed as long-term investments. Institutions and family offices always thought of this as my patient capital that I'm investing for the next 7 to 10 years and I'm putting it away. I think that is a little bit more challenging for advisors and investors who maybe aren't as familiar with it because the vantage point is thinking a mutual fund where you're in today and you're out tomorrow. So we're excited about these new structures coming to the marketplace, but I do think they need to have some training around what it is that they do and how it is that we're able to provide the benefits of long-term investing and some more flexible features around that.
Awesome. When you're thinking, like you mentioned that they're illiquid and it should be long-term, what is the right investment horizon if you're thinking about it? Is that, when you say long-term, is that 3 years, is it 5 years, 7 years, or longer?
Yeah, I think I'll go back to what you said before, how do you select a fund? I think that's part of what you want to do in the beginning is you want to determine how much of your capital are you willing to invest for the next 7 to 10 years? And you can almost do the backward math on it. I wrote a paper called The Cost of Being Too Liquid. And if it's helpful, we can certainly provide it at the end of the podcast.
Absolutely.
And really what it did is it kind of laid out the whole map of this, which is we all know the reason you allocate capital to private markets is the potential for that illiquidity premium, that excess return that you get for tying up capital for an extended period of time. That's the easy part. And I could show you the data and you know the data well. It's a really compelling story. But it's that emotional part of it that is so difficult, right? The emotional...
sorry about that, but can you just get for the people who aren't familiar with a liquidity premium, what is a GIP premium? And just spend one more second on that.
Yeah, thank you, because I can go on and we kind of miss our audience. So in the industry, we refer to this term illiquidity premium, and it's easy maybe to use an example of private equity versus public equity. And the illiquidity premium is the excess return that you get for tying up capital for an extended period of time, giving that manager a longer runway to unlock value in those private companies. The perfect example of that today, of course, is we just went through SpaceX going public, and we need to remind folks that those private enterprises go on a journey. When I was working at Morgan Stanley with a lot of our banking clients, typically the runway was 3 to 4 years before a company went public, and you hope that they would be successful, recognizing that not all companies would, but those who were successful were wildly successful, offsetting the losses. Today, what we find is many of those companies, like a SpaceX, which is a 24-year-old company, chose to stay a private enterprise because it afforded them more freedom. Elon Musk had more freedom to execute that long-term strategy, to perfect the rocket launches and all sorts of things that would have been very difficult to do in the public domain. So when he decided that the time was right, he brought the company public 24 years afterwards via an IPO. So we need to recognize that those companies often need a longer runway. So if the runway used to be 3 to 4 years, maybe today it's 7 to 10 to 12 years, depends on each company. But ultimately, you will be rewarded when those companies go public, or either in the form of an IPO or there's an M&A transaction. So I think we recognize, and it's easy to kind of get our arms around the fact that many of those companies will be wildly successful, and therefore there's that excess return that we get. I think what we don't often spend the time thinking about is why is that? They have a longer runway to execute the strategy. They're not encumbered by thinking about quarter versus quarter and meeting shareholder demands and people micromanaging everything going on. So Derrick, as an entrepreneur and somebody who runs a business, I'm sure you can appreciate that long-term lens gives you greater freedom. That's really where the illiquidity premium comes from. It's the unlocking of the value over a longer period of time rather than that shorter period of time. That's referred to as the illiquidity premium. But to capture that, we need to change the mindset of individual investors to think patient capital, long-term capital, 7 to 10 years.
And then if you're going to lock capital up for that kind of time frame, what kind of premium should an investor be expecting? If you're going to say, and I know it might be different by market, it might be different in private equity and private real estate and private credit. We'd love to get your perspective on what is appropriate and appropriate.
Yeah, it's going to vary. It's going to vary versus the time period, and it's also going to vary based on what the underlying investment is. So for private equity, historically, the illiquidity premium has been something of the magnitude of 300 to 500 basis points. Now, as I say that, there may be periods of time like the last 3 years where the U.S. markets had delivered oversized returns and it's a little bit more challenging. But over the long run, the expectation is maybe a 300 to 500 basis point illiquidity premium for private equity. Private credit, again, we expect to get the excess return. But the other thing we're getting there is we're getting that incremental income, right? So we're getting substantially higher income than we might get in the market. And the area that you know best, real estate, is I'd argue real estate is one of these multifaceted tools that can provide excess return, higher income, better diversification, because private real estate historically has delivered low to negative correlation to traditional investments and the ability to hedge inflation. So it's kind of the four-pronged sort of approach where those tools can be used in a lot of different ways in client portfolios. So I don't want to focus solely on that excess return that you get, but that is typically one of the components that people are latching onto.
Okay. For a regular investor or their advisor, how should they think about how much of their portfolio belongs to private markets? And, talk about what does like a goals-based investment strategy mean?
Yeah. So again, I'll go back to this paper that I mentioned, the cost of being too liquid. And I think mathematically, you could easily make the argument that a 20 to 30% allocation on a client portfolio would be additive, but it may not be prudent for all clients, right? And it may not be prudent because people may have needs for their money. In the paper, again, I start with this intellectual argument, which is very easy, which is I can see the returns on a piece of paper and I want some of that. The more challenging thing is how much of your capital are you comfortable giving up? So I actually created kind of a series of questions to probe to understand how much of an investor's portfolio are they comfortable committing for the next 7 to 10 years. My guess is for most high net worth investors, most of the folks on your call, that could be a 10% allocation, a 15% allocation. If I view that differently, that's my long-term patient capital. The next time there's a bump in the road, and we all know there will be one, I would probably think about changing the composition of my traditional portfolio, right? I de-risk the portfolio. I take a little out of my equity allocation. Maybe I'd add some gold or something to buffer the volatility. But at least for that long-term capital, I'm not touching that. I'm viewing that as long-term capital. I'm putting it to the side. And what I'm really teaching investors to think about is how do I invest for the long run? Right. And I think that's a valuable sort of thing. I think as they go through that experience, and maybe they start with a 10% allocation and they have a positive experience, they're now more apt to increase that allocation over time, right? They've had a good experience. They've got that long-term reward, and they understand it's really a good thing to embrace a long-term mindset as opposed to reacting to all the whims in the market. So I think that could grow over time. So I think that's clearly one way of thinking about it. The other thing, of course, is to think about what is it that I'm solving for? And, if I'm solving for, I want more return in my portfolio, I'm probably going to have a higher private equity allocation. If I'm solving for, I want to generate more income in my portfolio, I might think of using more private credit and private real estate to generate more income. So there's a lot that we can do. It's beyond just what the percentage allocation is, but within that percentage, what sort of tools are we using? And how do we expect them to perform?
Yeah, that's awesome. That's awesome. So something that's very topical today is private credit. I guess it's been topical for the past several years.
Yeah.
Both because it was a darling and now it is it's not so much. Can you talk, what are your thoughts on red flags or things to think about when, the headlines are either positive or negative, and would love your take specifically within the context of private credit.
Yeah, I think you're 100% right. It's definitely in the headlines and it's a little bit misunderstood. So in the wealth channel, roughly 50% of the flows into these evergreen products has been private credit. It was kind of the first introduction, so a lot of capital went into it. And you're right that I think some of the headlines have been negative, people suggesting, Jamie Dimon famously suggesting that we had a cockroach problem, suggesting that we're going to have more defaults and all of that. The ironic thing what Jamie was referring to wasn't even a private credit transaction. What he was referring to was a CLO and conflated those two issues. And of course, everyone panics. Is there something that we should be aware of? We have done a lot of research. And again, my role at the Franklin Templeton Institute is to do independent research. I have nothing to do with our product offerings. I just want to research what's going on in the industry and understand for investors whether we perceive any risk in the market. We don't see it. We haven't seen a pickup in defaults. Now, with that said, I do think there's a couple other things to think about. So there's three primary things in the marketplace. First was, is there systemic risk in private credit? We would say no. The second thing that got a lot of headlines earlier this year was software as a service. Claude came out with this statement that, AI is going to replace software and therefore software is going to become obsolete. And I think a little bit of an overreaction, but the concern was that the private credit managers were underwriting a lot of that, and many of those funds had very large exposure to software. And I'm going to show my age here a little bit and suggest that although I think it's a risk, I don't think that we treat everything with the same brush. I recall, the internet was going to replace everyone and jobs were going to go away. And I think what we found is many companies evolved. They thought of different verticals or they evolved their business to respond to a changing environment. I suspect that will be the case with many companies. It's not to suggest that some companies may not have challenges. Some may have to write down positions, but I think we shouldn't overreact to it. We should watch it carefully. And by the way, if that's a concern for private credit, it's probably a concern for private equity as well. Remember, from a cap stack perspective, private credit is going to be more protected than private equity. So that is something we are watching carefully, but let's not paint everything with the same brush. I think what has got the most headlines, though, is the redemption in some very high-profile BDCs where people wanted their money back. And to me, I think the biggest issue there is we probably didn't spend enough time as an industry emphasizing these are illiquid investments and they have quarterly liquidity provisions, typically 5%, but that doesn't mean that you should be in today and out tomorrow. And I think what we have experienced is a little bit of this run on the bank mentality where a lot of people panicked and said, I want all my money back. And many of those funds said, well, wait a minute, we have a 5% redemption there for a reason. And I'm really not a fan of going beyond the 5% redemption because I think it's important to remind people why it's there. And the price that you pay in having these evergreen fund structures is you do need to maintain a liquidity sleeve. Most funds have a liquidity sleeve, and maybe that's 10 to 15%. That's to meet redemptions. I'm going to be honest, that's a little bit of a cash drag. I actually, if I'm a long-term investor, I want to reap the benefits of allocating capital. So I don't want to force these funds to maintain more cash or liquid type investments to meet redemptions because ultimately there's a price that you pay for that. So I'd argue the redemption issue is something that is a little bit self-inflicted. It's an area where we as an industry need to do a much better job sensitizing both advisors and investors that these are illiquid investments. If I want to capture the benefits of them, I need to think of them as 7 to 10 year investments. And while they're quarterly liquidity provisions, it doesn't mean you can get all your money back and you should head for the exits whenever you feel uncomfortable.
That's great. We spent a good amount of time on private equity and private credit. I know you do research across privates. What are your thoughts on how someone like a typical investor should think about allocating across private equity, private credit, and private real estate? Is there a way to, is it a timing type thing? What are your thoughts on what's attractive right now and how you think about allocating in today's environment?
Yeah, so I would say that we think real estate looks very attractive here. And you know this market well. Real estate valuations are down substantially. 22, was a little bit of a headwind as we started to see rates rise. Rising rates can be a headwind for real estate. but also there were concerns about Silicon Valley Bank collapsing and would other banks have similar sort of exposures on their balance sheet. And then, of course, there was the concerns about the office sector. So I think the confluence of events caused a lot of real estate valuations to come down pretty substantially. So our view is real estate looks really attractive here. We see a lot of real estate available below replacement costs. And you talked about private credit. Our view on private credit is we actually like real estate debt. So if you're a credit manager, we like real estate debt because we see something of the magnitude of $2.6, $2.7 trillion that will need to be refinanced. And we know that banks aren't going to be lending capital. So we think private credit managers can step in, dictate the terms, the conditions, and the covenants. And we think that's an attractive place to be. Now, with that said, painting the picture that we think real estate, both equity and debt, look attractive here, we would be very specific that the office sector, in our view, still looks challenging. So there are areas we think it's very much a sector call. We like the industrial manufacturing sector, makes an awful lot of sense to us. We think about all of the deglobalization and reshoring, shoring up our supply chains. We think that's a benefit. We think the e-commerce build out, Amazon fulfillment centers are all very good for the industrial warehouse sector. We like multifamily housing. We understand in America we're underhoused by 3 to 5 million units. And we understand that multifamily is a great way of kind of getting that start into real estate. And then we like certain areas like senior living. So again, I think there are smart ways of allocating capital, places that look attractive, parts of the country that look attractive. And there are areas that are problematic, most notably the office sector. So I think smart allocation of capital, focused on where the attractive valuations are, makes an awful lot of sense in this environment.
Awesome. So say you've done the work, you've found this is the part of the market. I want to have some amount of my my risk capital or my long-term capital in private real estate. I want some of it in in private credit, some private equity. These are some kind of managers that I'm looking at. There's a difference between access, which there is more access now than in the past, and good access. What are things about a structure or like a fund that are important if you're thinking about making an allocation? There are 1,000 funds. Like, what are some things that to particularly be looking at as you're doing your diligence and making that decision?
Yeah, I think due diligence is so critical in the private markets. This isn't an area where you want to invest in somebody who doesn't have the experience. So we think think of the 4 Ps, right? People, process, performance, philosophy, absolutely critical. And people in particular. People at the end of the day make all the difference in the world. So you really want to have deep and dedicated resources. You want to make sure you have a team that's been doing this for good times and bad for an extended period of time. I think ultimately you make the decision based on the people that you're following, people who have, again, managed funds effectively. And then secondarily, then you think about the structure. And again, the structures available in the marketplace, let's just call the first generation fund a drawdown fund. Nothing wrong with it, but it has some limitations, right? Those are long-term commitments of capital. They tend to have very high minimums. They may only be available to accredited qualified purchaser or above. So you're talking about 5 million in investable assets. So they may not fit for all clients. The other strategy and structure that we've talked about, which is the evergreen structure, and again, I'll describe evergreen as the broad structure, kind of a hybrid structure, but that typically includes interval, tender offer, non-traded REITs, and private BDCs. All of these hybrid structures that have attributes of allowing a manager to invest for the long run, but more flexible features like lower minimums, lower accreditation standards, more flexible quarterly liquidity provisions and all of that. So I think the structure is very important, but I think the discussion has to start with the manager. Get the right manager, make sure they know what they're doing, and then we can determine what the right structure is afterwards. Many managers, of course, will offer strategies available in both a drawdown and an evergreen structure.
So I want to double click on 2 things there, because, people are, looking and trying to make sure they're doing their due diligence. You emphasize manager first. Manager is the most important. What are, you mentioned, track record, of going through and doing this for a while through good times and bad. And but what are some other just like are there any key pillars, like make sure you do this, or key red flags if you're going to double click on manager selection?
Yeah, I think there's a lot. I mean, I mentioned the 4 Ps, and those are kind of easy to think about. I think the other things to think about is, think of the soundness of the organization, right? Is it an organization that has deep and dedicated resources that can properly source capital, right? It's very different than an active manager who can look at publicly available information. You need specialists who really understand what's happening in the marketplace. And then from a structure perspective, I do think it's important to look under the hood, because the reality is, two funds that may sound very, very familiar and very similar in the way they describe themselves. And then you look under the hood and you start to realize they're different, right? They do use different types of leverage. They may have different fee structures. They may have different underlying holdings. So I always think you want to start with the manager, break them down, get comfortable with that. And then as you get into looking at the fund, peel back that onion one layer at a time. Understand what the underlying holdings are, right? Some funds are going to be more diversified. Some are going to be more concentrated. Understand, are they using leverage? And leverage, by the way, isn't inherently good or bad, but it clearly amplifies the return on the way up and can also do the same on the way down. Understand the fee structure. Fee structures can be a big impediment to performing if there's multiple layers of fees in there. And then performance fees, again, not necessarily good or bad, but it makes it harder. There's a little bit of a hurdle that you have to overcome. So again, I would ask the questions and just peel back that onion one layer at a time to get comfortable with it, because ultimately you're making a long-term commitment of capital and you want to make sure you make the right decision in the first place. It's part of the reason that I think the evergreen structure has really resonated with the wealth channel, because you don't want to make that quick decision. Somebody's in my office today, and if I don't buy it today, I'm not going to be able to buy it tomorrow. You all need to get comfortable at your own pace. All of your listeners need to get comfortable. And the more time that we give them to do that, I think the better.
Awesome. So I do want to go into structure, but just given how important, and I have a few other market questions, but just given how important it is, the manager, you mentioned two things that I get a lot of questions on. Just love to hear your perspective. So one is fee structure. What is good? What's the what things to look at in fee structure? We're like, oh, this is a good, and what are like, this is definitely gonna cause potentially gonna cause problems.
Yeah, so this might be a little controversial. I don't know that in the private markets we want to gravitate to the low-cost provider. I think that's the case in the traditional markets, and in part because we don't see a big dispersion of return. And Derrick, as you know, there's a big dispersion of return between the winners and the losers. So I don't know that I want to gravitate to the low-cost provider. What I want to do is make sure there's a reasonable value for what I'm paying based on the return that I get. I'm not a big fan of performance fees just because, again, I think it makes it, harder to generate returns, but there's nothing inherently wrong with it. So if you could have a simpler fee structure, a lower fee structure, that's good. But don't automatically gravitate to the low-cost provider is the best solution here. The low-cost provider is probably a low-cost provider for a reason. And I'm more focused on getting value and return. So I look at return and the fees side by side, and I'm willing to pay a little bit more if I know I'm going to be handsomely rewarded for doing so. And I don't know that I want to have my lowest fee as the preferred option just because that's the way that we tend to think of things in the traditional space.
Nice.
The Vanguard model.
Right. It's hard to do the Vanguard model in private real estate, certainly, and definitely these other places as well. Also, you talked about leverage. Like as a real estate, this first someone who's been in the real estate space, and then before that in the security space, I see leverage as risk. That's my natural inclination. But talk about leverage. In your mind, what is good leverage? What questions should you be asking? Where should you say, oh, wow, this seems good, or this seems like, might be a red flag?
Yeah, leverage isn't inherently bad. It's just something that you have to be mindful of and just recognize that it's going to amplify things. When leverage is a great thing on the way up, right? Because it amplifies the return on the way up. But as you and I know, we've also seen where it hurts us when things are going down and all of a sudden leverage and the use of leverage is driving your decision making rather than looking at fundamental factors. So I don't think that leverage is inherently wrong, but I would be leery of somebody who's using too much leverage in their fund, too much dependent on leverage to generate the returns. I think at the end of the day, when you're making investments, you want to make sure there's a fundamental case for it. Using capital intelligently, that's always a smart thing. But I think at the end of the day, there's got to be an inherent value on what you're investing in, and you have to see a higher return potential down the road. So again, I think it's a good thing to ask about leverage and understand it, and maybe shy away from exorbitant amounts of leverage. But leverage in and of itself isn't the problem. It's when it's used too much.
Awesome. Before, we spoke a little bit about managers and how to diligence that. Earlier, you were talking about different structures, and you ran through several, drawdown funds, BDCs, even within evergreen funds, there are different kinds. Can you talk about some of the pros and cons of the different structures out there, and just go double click, spend a little bit more time on what is attractive in the market now, and how you think about how an advisor should think about that?
Yeah, so maybe I'll take a little bit of a step back. We talked a little bit about private credit, and we talked a little bit about real estate, and I shared where I think there are really attractive opportunities in real estate, equity, and debt. One area that I think is particularly interesting now, and it's our highest conviction idea. So from the Institute perspective, we came out with our outlook in the beginning of every year, and we're trying to look not just, what's going to happen in 26 and 27. We're actually looking down the road. But I would tell you the area that we have been the most constructive on for the last couple of years is the secondary market. And if we think about what's happened in private equity, we've seen a ton of capital flowing into private equity leading up to 21 kind of peak valuations. All of a sudden, 22 is a challenging year, and then 23, 24, 25, one of the things we experience in the marketplace is a slowing of exits. So we talked earlier about SpaceX and IPOs and M&A. Typically what you want with private equity is you want money coming in the door, that's fundraising, and you want money going out the door, distributions or exits. Distributions and exits have slowed dramatically since 22, which has caused a little bit of a bottleneck. So one of the phenomena that we've seen in the marketplace is big institutions like the Harvards, the Yales, the CalPERS, and the CalSTRS kind of woke up and recognized, we're over allocated to private equity. And in fact, to make things worse, we're committed to the next deal and the next deal and the next deal. So we need to find a natural buyer of our positions. That's the secondary market. And secondary managers have really been able to reap the benefits of this need for liquidity in the marketplace. So a secondary manager comes in one of those situations and says, I'd be happy to buy those positions. I'd take them off your hands, but I'm not willing to pay 100 cents on the dollar. So I buy them at a discount. Very appealing. And what the manager gets, and ultimately what the individual investor gets, is they buy seasoned assets, right? Those positions have been on the books for a while. So ideally, what an individual investor gets when they invest with the secondary managers, I've got diversification across GP, vintage, geography, industry. That's fantastic. That's exactly how I want to think about my private equity exposure. But structurally, the advantages I get, because I'm buying some of those seasoned assets, I'm shortening my duration of my fund. I'm shortening that J curve. I'm getting my distribution of capital back sooner. So there's structural advantages there as well as the fundamental case for that. Now, I'll offer one other. So those are typically referred to as LP-led transaction. You're buying it from an existing LP, an institution, let's say. The other phenomena, and this is more apropos to the discussion we had earlier about SpaceX, which is we now find some of these funds owning very seasoned positions, prize assets. The fund is ready to shut down, but it still owns a SpaceX. Right? It's a 10-year fund, but all of a sudden SpaceX is a 24-year-old company. So we have this prize assets. Derrick, would you want to own a piece of SpaceX? Well, I could offer to you in what we refer to as a continuation vehicle or CV. And those sort of transactions have actually picked up quite a bit. So the secondary market, which really started as more of a niche market maybe 20 years ago, has really matured. And we now see a robust LP-led secondary market, buying from institutions who need liquidity. We think that continues. And then we also see a growing GP-led market, which are these prized assets that gets packaged in either a single or a multi-asset continuation vehicle. So we think that's a really, really rich opportunity. That has been our highest conviction idea. we think that's a great idea for the next 10 years anyways.
Oh, yeah, 10 years. I have seen those, and those are very attractive, and it makes sense because you have to get liquidity, and liquidity is value for those LPs. So last couple of questions here for you. So after a lot of cycles, what's you've seen a lot of cycles. What's the one thing that you wish more people who are coming to the private markets today would think about as they're coming in and making their decisions?
Be patient, right? So institutions and family offices have allocated huge amounts of capital for decades and decades. They've had positive experiences, but they thought of this as a long-term investment. It's a little bit more challenging for advisors and investors. We're all wired emotionally, right? We all know this, right? But we can't work against ourselves. And the temptation is anytime there's risk in the market, the temptation is to sell at the wrong price for the wrong reason at the wrong time. We've seen it over and over again. Derrick, for as long as you've been doing this and for as long as I've been doing it, the temptation is always when things feel the most uncomfortable to head for the exits. That's often the best time to invest. So to me, the best advice for anyone thinking about starting on this journey, carve out a portion of your capital. Think of that as patient capital. Let it do what it's supposed to do, and don't tinker with it whenever you feel the temptation to. Carve it out separately. If you want to be more tactical, you want to kind of respond to changing market conditions, do that with your traditional portfolio. But if you do that with your private market portfolio, you're going to be rewarded in the long run. So my advice for everyone is avoid the temptation, avoid that emotional impulse to do the wrong thing at the wrong time for the wrong reason, and truly invest as a long-term investor.
Awesome. I know you do a lot of work putting out important information to investors and advisors, white papers, blogs. What's the best way for people to, learn more and to be able to, learn from your wisdom, Tony?
Yeah, so there's a couple ways. One is on LinkedIn, and I publish almost every week, either a podcast, a blog, white paper. I happen to be speaking at a conference. I'll post it just in case advisors want to come and visit, stop by. I'll also do book signings at a lot of those events too. The other thing is you can look at Alternatives by Franklin Templeton. We have a website. Go under the Knowledge Hub. Knowledge Hub has all of our content organized there, easy to reach. But look, I would say this is a journey for all of us. Derrick, you and I have been doing it for a long time. For many of your listeners, take advantage of all of the resources. Take advantage of resources that we produce, which is really designed to help you. Derrick, I'm sure you do the same. There's a lot of organizations out there who are focused on providing education like Kaya. We're all on this journey together. We all win together if people make better informed decisions. And at the end of the day, I think it's a tremendous time for our industry to have these incredible tools at our disposal that now can be used by individual investors. And you mentioned earlier the fact that they're starting to become available in retirement plans. What a great opportunity for my children to invest in these tools.
Yes, well, thanks a ton. And we didn't talk about retirement plans. I have this on my sheet. You can is some of these are privates are being able to go into 401ks or retirement plans, which is, as you said, a great opportunity because that is naturally long term. And then you have the tax benefits. Double click on there at all, and like what people should be thinking about putting into their retirement plans.
Yeah, it's something where I think we're going to go slow as an industry. We've been doing a lot of work on this for a long time. If we just kind of look at the retirement market broadly, the defined benefit market roughly has a 30% allocation to alternatives. Again, broken down between private equity, private credit, real estate, hedge funds, infrastructure, diversified portfolio, but they have a 30% allocation. In the DC market, the 401k plans, the target date funds, the allocation is less than 1%. So there's a lot of work being done. There's some industry groups like Tecalta. I've been very involved in writing and speaking about it, where we know where we want to go as an industry. We believe that the target date fund structure is the best structure because they should be a sleeve, not something on the menu, because we want to make informed decisions. We understand they're illiquid, so there's got to be some training around that. There's got to be some liquidity management. Fiduciaries, whoever they are, need to get comfortable with the underlying funds that are available to them. So as an industry, I think we are starting that journey, and the expectation is a decade from now, we'll be more like where the DB plans are today. But it's not going to happen overnight, and it's going to happen in a slow and methodical way. So for your kids, they will have those options available, and you can help them select what's the right overall allocation and how much of that allocation should be allocated to private markets. So I'm very excited. I think we've talked about it for a long time. There's been a lack of inertia. I think that has changed. I think we have some guidelines from the Department of Labor, which I think are all reasonable sort of guidelines. And I think as an industry, we are all working together to solve this, understanding these are better outcomes for individual retirees. So I think we're going to get there, but we'll get there in a methodical sort of fashion.
Awesome. Tony, thank you for joining us. Yeah, this has been great. Love to, stay in touch and maybe have you back on next time something topical happens in the space.
Love to. Thanks so much for having me, Derrick, and I hope this was helpful for your audience.
And thank you for listening to the Real Asset Intelligence Podcast. Find out more at usenectar.com.